5 top forever stocks. The performance of the stock market has been quite disappointing recently. A question on every investor's mind is if the golden age of stocks has passed. Most stocks have been doing poorly with the recent market decline caused by inflation and a hike in interest rates, and some have declined by more than 50% in the last few months. Even with this poor performance displayed throughout the stock exchange, some stocks have shown that you can buy, hold, and keep on autopilot for a long time. These stocks might not be the sexiest companies out there, but you can grow your investment with them. Keeping up with our goal of bringing life-changing investment opportunities that have the potential to make you financially independent to your doorstep, we will be discussing 5 top forever stocks today. Forever stocks are stocks that you can hold for decades. The stocks in today's video were compiled by our team of analysts after sifting through various stocks, and these were our favorites. We appreciate your support, and if you find our stock picks valuable, make sure you obliterate the like and subscribe buttons. Stay until the end of today's video to see our last stock, which is our best pick, Microsoft, MSFT. So guys, our first stock pick today is Microsoft. Undoubtedly, Microsoft needs no introduction to most of us. Microsoft Corporation is an American multinational technology company specializing in computer software, personal computers, cloud services, consumer electronics, and other related services. Microsoft apps are very popular, and you may have one of their apps running on your mobile device. Microsoft is one of the big 5 American information technology companies with around $200 billion in total revenue and over 200,000 employees. During the COVID-19 pandemic, MSFT boosted its earnings as the crisis became an opportunity. Due to the stay-at-home policy, there was an increase in cloud computing and more Xbox sales as people played games to while away time. The company's stock price doubled after the pandemic from around $180 to over $340. Although the stock is now priced at about $255, it is still more than 40% higher than its pre-COVID values. The company's recent third quarter results generated over $50 billion in net profit. The strong performance in this economic weakness is a testament to the company's resilience. Microsoft has been a top large-cap performer over the past 5 years, and its long-term appreciation potential is one of the main reasons it debuts as our first stock pick today. With sales continually on the rise, MSFT numbers look good. Taking a look at the company's dividend yield, it has a dividend yield of a little over 1.0%, which is not too far from the sector's median. The company's dividend payout ratio is around 27%, meaning the company has no problem with dividend payments. Although Microsoft is not yet a dividend aristocrat, it has paid dividends for 19 consecutive years and is also on an 18-year streak of dividend growth. MSFT needs 7 more years of straight payment to join this exclusive club. Over the last decade, Microsoft's earnings per share grew by over 15% annually, and the company's dividend growth rate in this same period was around 13%. Our conservative analysis predicts that the EPS growth rate will be approximately 10% per annum in the next 5 years, while the dividend growth rate will be around 9% annually. In the last 9 years, Microsoft's return on invested capital has increased by around 10% from 23% in 2012 to 32% in 2021, averaging about 20.5% in that time frame. Our model suggests that Microsoft will be a good stock that you can hold for a long time. With its 5-year estimated annual return of 10.4%, most analysts give this stock a buy rating. MSFT is a stock to consider for the long-term haul. However, it is important to always do your own research. Becton Dickinson & Co. BDX. Becton Dickinson & Co. is a medical technology that manufactures, produces, and sells medical equipment, reagents, and instrument systems. It also provides consulting and analytics services. This company is second on our list of top forever stocks because of its strong history and potential to outperform the market. The company is headquartered in New Jersey and has a revenue of over $20 billion. In 2021, BD was ranked 177 in the Fortune 500 list based on revenue generated. While corporations in other industries struggled to keep their financials afloat during the pandemic, Becton Dickinson & Co. was tearing up, generating huge profits from selling COVID testing kits and other medical supplies used during the coronavirus crisis. Although the company was hit at the beginning of the pandemic, sales soon improved, and with it, the value of BD stock. At the height of the pandemic in March 2020, BD saw its stock fall to around $210 before quickly surging. The stock rallied to about $275 in March 2022 before a recent decline in October. The stock is currently priced at around $250. The recent decline in October and the company's divestiture from its diabetic line are some of the reasons we believe you should invest in this stock. We think the stock is currently undervalued. Let's take a look at the financials of the company. BD has a dividend yield of around 1.4% and an average 4-year yield of 1.3%, trading just about its average. The company's dividend payout ratio also stands at a modest 28.5%. Well respected in the medical supply industry, BDX is among the few dividend kings, having cemented its status among the elite with 50 years of consecutive dividend payments and growth. The company's expansion over the years is evident in its EPS and dividend growth rates. In the last decade, Becton, Dickinson & Co. has had an annual EPS and dividend growth rate of 8.4% and 7.0% respectively. Our conservative analyst model projects that these values will increase over the next 5 years, as it is estimated that the EPS growth rate will grow at 10% per annum and the dividend growth rate will also be 10%. Over the years, BD has seen steady revenue growth from each division. The company recorded an average annual ROIC of 7% in the last decade. With the dividend expected to grow at 10% per annum over the next 5 years, BD could see a 5-year estimated total annual return of 9.6%. This figure might not be as high as others you want, but it is very fair for a company with consistent dividend growth. This is not crypto. For long-term investments, steady and consistent returns are better than a single large one-off. If you want a stock that you can leave to grow unattended, you might want to consider Becton Dickinson & Co. JP Morgan Chase, JPM. Next up on our list of top 5 forever stocks today is JP Morgan Chase. JP Morgan Chase is a multinational investment bank and financial service provider. This corporation is the largest bank in the United States, the largest bank in the world by market capitalization, and the 5th largest bank in the world in terms of total assets. As a global leader in the financial services industry, JP Morgan offers solutions to the world's most important corporations, governments, and institutions. The bank specializes in investment banking, asset management, commercial banking, transaction processing, and financial services for consumers and small businesses. After JP Morgan released its Q1 results of 2020, it was evident that the coronavirus had ravaged the bank as profits dropped nearly 70%. A decline in overall profit from the companies means that the stock price is badly impacted. Rightly so, JP Morgan's stock value was down for more than 6 months, trading below $100 in those periods. It was not until October of the following year that the stock price hit an all-time high of over $170. The stock is currently priced at around $135. In recent months, JPM has relatively outperformed its competitors, and it has also cushioned the effects of rising interest rates as well. With a dividend yield of around 3%, JPM stock is trading a little higher than its 4-year average, which stands at 2.8%. Will JPM be able to continue paying dividends? The payout ratio will answer that. The dividend payout ratio is 33%, indicating that the bank has enough to pay its investors without using the company's earnings. JP Morgan has paid dividends for 8 consecutive years and has also seen an increase in dividend payments for the same number of years. The company still has some years to go before becoming a dividend aristocrat, where it's consecutively increased dividends for over 25 years. But if it continues to generate strong financial results, it might join this exclusive list. Looking at the bank's EPS growth rate, we can see that it has consistently shown growth in its EPS and dividend growth rates over the last 9 years, with the growth rates per annum standing at 9.3% and 14.3% respectively for both metrics. We project that in the next 5 years, the earnings per share growth rate will be 6% annually, while the dividend growth rate will be 5% annually. Banks usually generate a small ROIC, and JP Morgan is not an exception. The bank averaged around 5% ROIC over the last 10 years, recording its largest return on invested capital of 7% in 2021. The bank's values over the years are not bad either. While it might be a little too much risk for a short-term investment, JPM is in the mix for holding for the long-term haul. JP Morgan might be a suitable long-term investment if the recession worsens, given its history of maintaining stability. With an expected total return of 10% over the next 5-year period, you might want to keep your eye on this particular stock. BlackRock BLK. Alright guys, our 4th stock pick today is BlackRock Corporation, an American multinational investment company. One thing you should know is that BlackRock is the world's largest asset manager with over $10 trillion in assets under its management. BlackRock operates offices in over 30 countries. The companies have many subsidiaries after partaking in various mergers and acquisitions over the years. In 2021, BLK recorded around $19 billion in total revenue and had over 18,000 employees. As a leader in the asset management industry, BlackRock is known to thrive in most situations in which other businesses struggle. The exchange-traded fund business takes up funds from all kinds of markets, even during wars. Although BLK dipped sharply in the first quarter of 2020 due to global market turmoil, it soon rose like a phoenix as investors who panicked during the pandemic became emboldened as the global market recovered. Wallowing at around $350 in March 2020, the stock quickly skyrocketed to nearly triple its pandemic figure in July the following year. The stock is currently priced above $700. Even at $700 per share, which seems a little high, many analysts still think this stock is underpriced. The stock numbers speak for themselves. BLK has a dividend yield of over 2.7%, besting its 4-year average of around 2.4%. The company's dividend payout ratio is fair at around 50%, and we think the company can keep the payout ratio balanced and continue paying dividends without stress. You can also see that the company has kept up with dividend payments for the last 19 years, having paid its dividend consecutively. The company has had impressive earnings per share growth over the past 9 years, having experienced an EPS growth rate of 10.5%. The dividend growth rate has been more impressive over the past 8 to 10 years, with a 14% growth rate. Our conservative model suggests that the EPS growth rate in the next 5 years will be around 8%, while the dividend will continue to grow at about 6% annually over the next 5 years. BlackRock's financial statement has been excellent when it comes to revenue generated and return on invested capital. The asset management heavyweight increased its ROIC from 8% to 12% in 4 years, rounding to an average of over 10% in 10 years. When we value the company based on its growth and performance using our conservative model, it is estimated to have 5 years of annual returns of 7.6%. This estimated return might seem low, as the market generally returns about 10% annually, but forever stocks are slow, steady investors that grow gradually and compound over time. Although the company is experiencing temporary setbacks in a recessionary environment due to significantly lower markets, we expect BlackRock's broad offerings to be in demand for the long haul. This stock is one to look out for, and now may be a great time to consider this stock. Taiwan Semiconductor, TSM. On our last pick today is a stock that has enjoyed both short-term and long-term growth. TSM is a Taiwanese multinational semiconductor contracting and design company. It is the largest independent and most valuable semiconductor foundry in the world. The company also produces graphics cards, GPUs, controllers, and processors. The company has a revenue of over $55 billion and more than 60,000 workers. There was a reduction in global demand for semiconductors in the wake of the coronavirus pandemic in 2020. The company's stock declined, but the surge after this was breathtaking as the stock almost quadrupled its pandemic price. The stock slumped to around $45 in March 2020 before rising to over $140 in January 2022. At a current price of $82, TSM is still about double its COVID price. Virtually all electronics being produced now need a semiconductor to work perfectly. Looking at how crucial the company is, Taiwan Semiconductor tops the list of our forever stocks because of its great positioning as a leader in its industry and robust demand outlook. Considering the digitalization of all aspects of human life, we think this company will continue to experience growth as it will continue to be in demand. So guys, let's look at the company's financial figures. TSM's market cap went through the roof after the pandemic, and an industry report tipped the company to grow by over 10% in 2022. Although the company's dividend is far from its 2020 yield of around 5.3%, it is still reasonably placed at about 2.3%. The company also has a dividend payout ratio of 5.8%. TSM has paid dividends consecutively for the past 17 years. However, its dividend growth has not been consistent as it has only grown dividends for 1 year. As a technological leader in the industry, the company has pioneered several semiconductor designs, leading to higher profits. This has streaked down to the company's EPS and dividend growth rates, which have been fantastic over the years. Only a few companies can boast of TSM's figures. TSM's earnings per share and dividend growth rates over the past 9 years as both stand at 21% and 15.6% respectively. We think the EPS growth rate can continue over the next 5 years at a rate of 9% annually and the dividend growth rate at 10%. Taiwan Semiconductor Manufacturing Company's return on invested capital has been relatively consistent over the year, averaging more than 20%. Amid the geopolitical risks that weigh on the company, it continues to benefit from its strong position as an industry leader. With an estimated 5-year annual return of 15.9%, we think the company is worth investing now, but of course, do your own research. That brings us to the end of our video today. Thank you for sticking with me until the end. Let us know your favorite stock in the comment section below. If you haven't subscribed, please kindly annihilate the like and subscribe buttons for more life-changing investing videos like this. Have a great day ahead.